Hi everyone, and thanks for tuning in to another episode of Budget Investing. Today, I'm just going to give you a quick update on what's been happening with my portfolio, and you'll see that there's been quite a bit of changes in here to make things a little bit easier to follow. And then after that, I want to give you my top 5 stocks that are on my watch list right now, as I believe they are undervalued stock. So, starting with the portfolio updates, as you can see, I've changed things just a little bit on this home landing page. But if I scroll down a little bit, this is really where things start to come to life for me. So I've added a few extra charts in here. I'm now tracking the growth of my dividends annually. My growth in 2020 was 0 because I didn't do anything in 2019. But already I've jumped up in comparison to 2020, 29%. I'm tracking my actual annual dividends, and then I'm breaking it down by quarter as well, as you should start to notice a continuing increase quarter by quarter. Of course, the second quarter for 2021 is lower right now because we're in just the first month of it. This year-over-year dividend income will gradually increase and become a little more accurate and easier to see the increase over time as more years go by. And now I've really started to track my individual stocks a little bit differently. So of course I can see the holding value. So as I've pointed out in previous episodes, my Costco holding is quite large in comparison to everything else. But my plan is to just increase my holding in all of my other stocks so that the overweighting in Costco will go down naturally. Also, I can see the dividend yield of my portfolio of each individual stock. So of course, there's going to be some higher and lower ones. PE ratio is a great one for myself of how I make sure that I'm not putting too much money into a current company that's really heavily valued or overvalued. BIP.UN is rated really high. It says it's at a PE of 85. Whereas I have some lower ones that are down at 13, that might be a bit of a better choice for my money right now. Market cap just lets me know the size of the company. So of course you have your Apples and your Microsofts, which are leading the pack, which shouldn't come as a surprise to anybody. And now I have my dividend CAGR, which is just the compounded annual growth rate. And this just lets me know which companies are growing their dividend faster. This is based off of a 10-year trend. Anything that's growing really quickly obviously stands out. For example, MasterCard, Visa, Microsoft, they've been growing really quickly. And then I've broken it down by all of my different sectors. So these are different previous charts that I've shown in the past, but I've just kind of put it all into one spot so it's easy to scroll through in one easy location. Hopefully this gives you an idea of what I've been doing. Now, I know you've been waiting to hear what are the 5 stocks that are currently undervalued that are worth taking a look into to potentially invest in. So I just want to give you a little bit of context first before I give you those 5 stocks that are undervalued. The entire economy PE has typically hovered around that 20 to 15 range. And of course, whenever we get a major crash, it comes after a huge spike. Of course, the most famous and notable one is in 2008 when we hit PEs of 120. And then of course, things dropped down. And then if you look at today, we're starting to trend closer and closer to that 40 PE ratio. So the economy is starting to get really overvalued. So it's really important that we're able to find ourselves some undervalued stocks so that we're not just kind of throwing our money away. And of course, this helps make us a little more recession proof. So if there is a downturn that comes, we're a little better protected from that. So the first company that I want to talk about is AT&T. Historically, AT&T has been pretty flatline. They don't really go up, they don't really go down. And they pay a fantastic dividend, which is nice for people that are looking to make money through their investments, but it doesn't give them an opportunity for growth. Again, if we go on that 5-year trend, again, every time they go down, they tend to come back up. They haven't fully recovered to the same price that they were before the major market crash in March. Now, recently, AT&T has made some changes to how they've been operating. They've been selling off assets that are more of a detriment to them. And they're starting to put their focus more onto areas that are going to make them more money. For specifics on that, they're really focusing on HBO and growing that streaming service. So HBO is kind of high-end streaming in comparison to some of the other companies that are out there. And they're really aggressively starting to pay off that debt. So they're becoming more and more attractive. Again, their PE ratio is around 9 and the economy is hovering around that 40 mark. So they're really undervalued, again, in comparison to everything else, and they haven't recovered to their highs of before COVID. Now, as AT&T continues to pay down their debt that they have, they're going to have more and more free cash flow so that they can continue to grow their stock, and they're going to become a more and more attractive purchase as an investor. So I would really take a hard look into a company like AT&T right now. All right, so my second choice is Manulife Financial Corporation. So Manulife is an insurance company, and one thing that I really like about Manulife is that they have a reoccurring revenue stream through those monthly payments that they receive for insurance. Now, as you can see, Manulife has recovered from their crash from COVID, so they're right around the same price that they were beforehand. Unlike the rest of the economy, they haven't really gained since then. So the global economy is sitting around that 40 PE. They're hovering around 9. Now, if you look at what a lot of analysts are saying about Manulife, they are saying that it's currently undervalued. It is worth so much more. They're making a lot of money, especially as the vaccine is continuing to roll out. That vaccine is starting to make insurance a requirement again as people are starting to travel a little bit more, just do more in their everyday life. And a huge thing that I really like about what Manulife is doing with their dividend is they've been consistently growing it almost at about a 10% rate, which is above inflation. They've been doing that for 7 years, which is a great track record. Of course, you'd like to see that closer to 10 years. It has been longer than 5, so that's fantastic. And that payout ratio is very low. They're only paying out 35% of their free cash flow into a dividend, so they're still sitting with about 65% of their money to reinvest into their company and continue growing. So as the world kind of reopens from COVID and things continue to improve, I think you'll really see a large increase in Manulife, and there's a great opportunity here for you. Okay, the next choice is AQN, or Alquanin Power and Utility Corp. So AQN is a power company, so they are focused a little bit more on renewables in comparison to using petroleum or coal or anything of that sort. They initially did recover from the COVID crash that they experienced. However, they did recently experience a bit of a step back or a pullback because of the severe cold weather that went through the states, especially on their power grid. Now, that will affect them negatively for about 1 quarter, but they will recover. Nothing's fundamentally changed about this company. And because of that little bit of a pullback, people are hesitant to buy into them currently. But as they show some earning reports that they weren't negatively impacted long term, they're really going to come back up and they're going to continue to grow. Now, the dividend for AQN is nice. It's around that 3.5%. It's still growing. It's been growing for 11 years at about a 10% pace, which is above the inflation rate. You might be a little bit hesitant when you look at that payout ratio of 87%, but you need to remember the utility sector is very hard to grow and requires a lot of infrastructure to continue to grow. So it's going to be slow. People are typically tied into contracts, so spending a lot of money to try and grow your company isn't as beneficial, so that's why they give it back to you in a dividend. As AQN continues to grow and recover from the little bit of the pullback that they've recently experienced, you will benefit from it, especially because they're currently undervalued by quite a bit. They're around that 11 PE, so this could be another huge opportunity for yourself. The fourth company that I want to look at is the TC Pipelines. So TC Energy is an oil and gas company, which on its own makes me a little bit hesitant to purchase into, but they are currently undervalued in comparison to the rest of the stock market. They've had a really rough couple of years between COVID, the pipeline being canceled by Biden, but there's still a lot of opportunity for them to continue to grow and make more money. They're a very large company, which is nice. They have a really nice dividend at about 6%, a little under. And they haven't been growing their dividend that long. It's only about 2 years, and the growth rate's only about 4.4%. So they're not growing a lot anymore as the planet is kind of shifting towards those renewables. And I know TC is trying to get into that. There's still just a long ways to go before that is a major part of their company. They're very focused on that oil and gas. Payout ratio, again, 85%. There's just not a lot of growth left for them at this point, but they are undervalued, so you could get in on a swing, make some money. Doesn't necessarily fit with my budget investing style, but there is that opportunity there. And if they are able to successfully transition into renewables, then this is a company that is well positioned for long-term growth in the future. All right, so the fifth and final stock that I have for you today, Alimentation Couche-Tard. Now, this company is better known as Circle K or Max or as a convenience store. As you can see that they have pretty closely recovered from their COVID dip of around 44 to 45 to where they are today. This company is rapidly growing still to this point. Their PE is around 13, sometimes around 14, depending on where they're priced at on any given day. And recently they had a major pullback because one of their large acquisitions got canceled by the government. But nothing's fundamentally changed about this company. They're still looking to continue to grow. They have gas stations at their convenience stores. Of course, they sell all kinds of food and anything else that you want from the convenience store. And they're trying to position themselves for long-term growth. The deal that got canceled was for adding electric vehicle chargers to their convenience stores, which would have set them up for the future as the world is shifting into that renewable space. Now their dividend is very low, it's only at 0.3%, but they've been growing it at about a 21% pace for the last 5 years, and they've been growing for 12 years, and that payout ratio is under 10%. So they have a ton of money to continue to grow their dividend extremely aggressively, and they have a lot of money to continue to grow their company as they have been doing for the last few years. Again, they're global, they're not just in Canada, they're not just in the States, they're everywhere. And I know people are saying that it's a critical year for them or that they're too cheap or anything like that. And I agree, it is a critical year. There is a huge opportunity for them to continue to show that they are a dominant force and that they are way undervalued. And I think this is a great opportunity to get in while there doesn't seem to be a lot of hype around them. This is a company that I am a big believer in, and I really do believe there's a huge opportunity here. Hopefully you found this information helpful and those 5 stocks give you something to take a look into, as things are always changing as the economy is adjusting and moving to different life factors. So just because something is undervalued today doesn't necessarily mean that it'll be undervalued tomorrow. So this could be an opportunity for you to capitalize on it while it's still down, but again, that might change in the short term. If you like this video, please remember to like, subscribe, and don't be afraid to share this with other people, as we'd love to grow the community so that we can continue to bounce ideas off of each other and grow as a group. Otherwise, thanks so much for watching, and I'll see you in the next video.